It's 11:30 p.m. on a Sunday in March of 2026. You've got work in the morning, but instead of sleeping, you're staring at a 6-inch screen in the dark, watching stock futures bleed red. You're doing the math. You know exactly which math I'm talking about. You're calculating how much your net worth just dropped in the last 4 hours and comparing it to your take-home pay. You're thinking that if the market opens down another 3% tomorrow, that's basically your entire salary for the year, just gone, evaporated. You start thinking about that vacation you planned, or the down payment for the house, and suddenly those goals feel like they've drifted 5 years further into the future. It's a gut-wrenching feeling. And yet, you can't look away from the ticker. Here's the thing. We've spent the last few years, 2023, 2024, and 2025, living in a world where it felt like you couldn't lose. Tech was booming. AI was the magic word that added $1 billion to market caps every time it was mentioned in an earnings call. And buying the dip wasn't a strategy. It was a reflex. It worked every single time. But now, it's 2026. The vibe has shifted. The headlines are getting darker. Global debt has reached levels that make 2008 look like a warm-up act. And that pit in your stomach? It's not just indigestion. It's the realization that you might actually be vulnerable for the first time in your investing life. Look, I spend way too much time thinking about the S&P 500's valuation and how human beings are basically programmed to sabotage their own wealth. If you're someone who lies awake wondering if you should move everything to a high-yield savings account the moment a chart looks ugly, or if you feel like you're the only one not prepared for a total meltdown, you're in the right place. Make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't going to look at vibes or TikTok predictions. We're going to look at the cold, hard math and the brutal history of what actually happens if the stock market crashes in 2026. Now, you might be thinking, I'm diversified. I've got my index funds. I've got some bonds. I'm safe. Maybe. But here's what most people don't realize. Your diversification only works when you don't need it. Think back to March 2020 or the 2008 Great Financial Crisis. In a true liquidity event, the kind of crash people are whispering about for 2026, correlations tend to go to 1. That means your safe international stocks, your growth tech stocks, and even your real estate all decide to jump off the cliff together, holding hands. In 2008, even gold, the ultimate safe haven, dropped 25% in the initial panic because people were forced to sell anything that wasn't nailed down to cover their losses elsewhere. Most people assume a crash is a 10% correction. Wrong. A 10% drop is just a healthy Tuesday in the crypto world. A real crash, a 1929, 1973, or 2000 style event, is a multi-year psychological war of attrition. As of early 2026, the S&P 500 has been trading at a Shiller-Cape ratio that puts it in the 95th percentile of historical expensiveness. To put that in perspective, if we were to revert to just the historical mean tomorrow, the stock market wouldn't just dip. It would have to drop by nearly 60%. Imagine your 401k being cut in half, and then having to wait 7 years just to get back to where you are right now. That is the reality of a valuation reset. Let's look at a concrete mathematical example, because this is where it gets really interesting and a bit scary. Let's talk about sequence of returns risk. Imagine two investors, Alex and Sarah. Both start with $500,000 in 2026. Alex experiences a crash immediately, a 30% drop in year 1. Sarah, on the other hand, sees the crash happen 5 years later. Even if their average return over 20 years is the same, Alex's portfolio might never recover if he's forced to withdraw money for living expenses while the market is down. This is the hidden killer of retirement. If 2026 is the year the music stops, the math of your retirement changes instantly. You aren't just losing money. You are losing the power of compounding on that money. But here's the psychological shift. You don't see $100,000 lost. You see 3 years of your life. If you save $30,000 a year and the market drops 20%, you didn't just lose numbers on a screen. You lost the equivalent of 1,000 days of waking up early, commuting to a job you might not love, and skipping those dinners out. This is why people sell at the bottom. It's not because they are dumb or don't understand Vanguard's philosophy. It's because they can't stand the idea of their past self working for free. They sell to protect what's left of their sanity. There's a concept I talk about a lot called the house money fallacy. In 2024 and 2025, many of you made incredible gains. It felt like house money, money the market gave you for free. When you're winning, you take more risks. You buy the speculative AI startups, the zero-day options, the leveraged ETFs. But the moment the 2026 crash starts, that house money suddenly feels like my money. The pain of losing $50,000 you earned from the market is 2.5 times more intense than the joy you felt when you first made it. This is why the same people who were aggressive investors in 2025 become ultra-conservative cash hoarders at the exact moment they should be buying. Now you might be thinking, I have diamond hands. If it crashes, I'm just going to back up the truck and buy more. Look, I love the enthusiasm, but let's be real. History tells a different story. In the year 2000, the Nasdaq dropped 78%. It took 15 years for it to reach a new all-time high. Could you really watch your account drop 10% every month for a year and keep buying? Most people can't. In a real 2026 crash, the narrative won't be stocks are on sale. The narrative will be the American economy is fundamentally broken and the dollar is dying. It is much harder to click the buy button when every news outlet is telling you the world is ending. What most people don't realize is that in a real crash, you might not even have the excess cash to buy. Let's look at the 1970s. Inflation was rampant, the market was flat for a decade, and unemployment was rising. If 2026 brings stagflation, where prices stay high but the economy shrinks, your primary income is at risk. Your emergency fund, which looked great in 2025, might only cover 4 months instead of 6 because of rising costs. This is the squeeze. You want to buy the dip, but you're too busy trying to pay the mortgage and keep the lights on. This is how the middle class gets washed out of the market while the ultra-wealthy who have infinite liquidity scoop up assets for pennies on the dollar. So, how do you actually prepare for a 2026 meltdown without becoming a doomsday prepper? First, you need to understand the yield-to-safety ratio. In 2021, cash paid 0%. Today, you can get 5% or more in ultra-short-term treasuries. This changes the math of risk. You are being paid to wait. If you have a major expense coming up in the next 24 months, a wedding, a house, a business launch, that money should not be in the S&P 500, period. The market is not a savings account. Second, you have to focus on what I call anti-fragile income. During the 1930s, the boring businesses were the ones that survived. We're talking about waste management, specialized healthcare, and basic utilities. If the 2026 crash is triggered by a debt bubble bursting, the companies with high debt-to-equity ratios will be the first to go to zero. You want companies with fortress balance sheets, companies that have so much cash they could survive a 3-year nuclear winter without borrowing a single dollar. Third, and most importantly, you must protect your psychological capital. Most investors fail not because of their portfolio, but because of their behavior. If checking your brokerage account makes you a worse spouse, a more stressed parent, or a less productive employee, you are investing wrong. In 2026, the winners won't be the ones with the best charts. They will be the ones who had the most emotional distance from the noise. This is where it gets really interesting. History shows us that every major crash is followed by the greatest transfer of wealth in human history. In 1932, at the bottom of the Depression, the price-to-earnings ratio of the market was 5. In 1982, it was 7. Those who stayed the course and had the discipline to keep buying when the world was ending didn't just make money, they created generational wealth. If 2026 brings a crash, it isn't a disaster for you. It's a reset. It's the market's way of clearing out the speculators and rewarding the disciplined. The math doesn't care about your feelings or your Sunday night anxiety. The math only cares about how many shares you own when the recovery eventually starts. And the recovery always starts. Even after the Great Depression, even after the World Wars, even after the 2008 collapse, the productive capacity of humanity continued to grow. 2026 will be no different. The question isn't whether the market will recover. The question is whether you will still be in the game when it does. Don't let a temporary decline in price cause a permanent decline in your standard of living because you panicked. Stick to the plan. Trust the math. Rebalance your risk before the volatility forces you to do it at the worst possible time. And for heaven's sake, stop checking your portfolio at midnight. Keep saving, stay rational, and I'll see you in the next one.